Well, friends, hi there and welcome to a brand new week. You're with us on Who Moved the Market. I'm your host, Surabhi Upadhyay, and with me on the show is Abhishek Kothari. Now, the reason we've had Abhishek back on the show is that it was a busy weekend. We had lots and lots of bank numbers coming through, but we decided to focus on the major private sector names, the big boys that reported over the weekend. Kotak Mahindra Bank as well as ICICI Bank. Now, Abhishek, it's been quite interesting because right from the morning, the ICICI Bank stock has held up. The Kotak Mahindra stock has been under pressure, 3.5%. So before we get to all the specifics and the details, you always sum up things in your own style in one line each. What would you say are the highlights this time around for Kotak?
See, for Kotak, X of treasury, or let's say the core operating profit growth, that's been very weak when you compare to peers. So X of treasury, the operating profit growth actually was a negative for SDFC Bank as well, but it was about 2.35%. For ICICI Bank, it was positive, or let's say rather flat, about 0.15%. For Kotak Mahindra Bank, it was a decline of 6.74%. So that's a massive decline that they have lost out on their core operating profit, and that's seen with the stock price reaction post earnings that you are seeing for Kotak Mahindra Bank.
Okay, that explains why the stock is reacting the way it is.
Because people fear that treasury gains may not be sustainable going ahead. Net interest margin has come in under pressure. So will we see core operating profit growth out in Q2, or will we see a decline in core operating profit on a sequential basis? That's a fear.
Sure. Fair enough. But I know that you've been warning us that this quarter expect some compression in margins for most banks, and some of that has started kind of playing through. So therefore, not much of a surprise, but still the street is, let's say, quibbling about it. Okay, if I start with Kotak and we start breaking down the performance, in terms of the deposit growth or the growth in the business, the loan growth, how does Kotak fare on those fronts? No problem over there at least, right?
But they are late to the party.
Oh.
I'll explain how.
Okay.
Look at SDFC Bank. Over the last few quarters, deposit growth has outpaced loan growth for them. So they were really concentrating on the raw material available for business, right? And this quarter, they didn't have much of deposit growth because even if you take a look, the CD ratio has been largely stable for SDFC Bank. But for ICICI Bank, the deposit growth has come in this time around. For Kotak Mahindra Bank also, deposit growth is pretty robust this time around. You are talking of a deposit growth when the interest rates are at their peak, or the interest rates are the highest in last many years on the liability side of the balance sheet for banks. So deposit growth is about 1.6% quarter on quarter for SDFC Bank, about 4.9% for ICICI Bank, and 6.4% quarter on quarter. What is happening is that across industry, the CASA ratio is declining. So incrementally, whatever deposit you are getting is actually coming at a higher cost, because term deposit rates have been increasing since November onwards.
Absolutely. I know I've done that. Why leave any money in the savings bank account? Just put it in FDs when you're getting the good rates, right? That's, I think, what most people have done. So again, not something that comes as a surprise, but it's showing up. Okay, so let's now talk about this net interest margin picture, where you said that it will start declining, and it's happening. For Kotak Mahindra Bank, I think quarter on quarter, the decline is only 15-16 basis points. So, that way it's not much. But is it still sort of a negative for the stock or for the market?
No, it's not negative. 5.57% for a bank net interest margin by no mean feat is small. By any means. If it was 2.5% or 3%, then we would have said it's weak. But if you're coming down from 5.75% to 5.57%, it's okay. Take it with both the hands that the net interest margin is on the stronger side for Kotak Mahindra Bank. If you take a peer comparison, it's perhaps the highest decline that Kotak Bank has seen. For SDFC Bank, it was flat. For ICICI Bank, a decline of about 9 basis points, while for Kotak, a decline of 12 basis points rather. And for Kotak Mahindra Bank, it's 18 basis points on a sequential basis. But remember that, Kotak CASA ratio has actually dipped the most amongst other lenders. So SDFC Bank saw its CASA ratio decline by 250 basis points. For ICICI Bank, the decline was about 255 basis points. But for Kotak Bank, the CASA ratio alone declined by 380 basis points. So the incremental cost
is increasing.
Yes, incremental cost of funds have actually increased more for Kotak Bank when compared to others. But still, 5.57 is no mean feat in terms of net interest margin on a quarterly basis.
Okay, I'm going to now talk about some of the segments or some of the areas which I guess people are debating whether there's any reason to worry. Otherwise, asset quality, I think at a gross NPA level, that's not a problem. But for Kotak, what we've seen is that the slippage ratio has increased. Should that be any cause of concern whatsoever, or is it, maybe just a seasonal factor?
Perfect. It's a seasonal factor.
Okay.
Q1 versus Q4, you'll always see rise in slippages because there are many factors like agri portfolio or some other retail portfolio which goes bust. So across these three banks, SDFC Bank also saw slippages rise by 18.4% quarter on quarter. For ICICI Bank, the increase in slippages was about 23.8% quarter on quarter, while for Kotak Bank it was at 46.4%. Now, given the fact that Kotak is largely a retail based lender, it does not have much on corporate side. More than 60% or 65% kind of a book is in retail segment. The unsecured portfolio or the agri portfolio, or some of these can slip into NPA. The others have the cushion of corporate portfolio not going bad, but from the retail and agri space, yes, there is a seasonality in nature for the banking sector to witness incremental slippages in Q1 versus Q4.
Okay, so that explains it. But as you're saying, if it's seasonality, then nothing much to kind of read into it, perhaps.
Yes.
Speaking of what part of the book has grown, I'm looking at the year-on-year trends. Home loans and LAP up 17.5%. Personal loan and credit cards, huge growth, right? In this parts of the business.
So over the last few quarters, Kotak Bank has been focusing on unsecured segment. They have a target that they'll take it up to about 10 to 11% of the portfolio. Roughly is what I remember. We need to cross-check the exact number, but it's now at 10.7%.
Okay.
And in a rising interest rate scenario, all of them are focusing on unsecured business, all meaning to say ICICI Bank as well. So
yeah, even for them,
ICICI Bank, the unsecured portfolio is now close to about 20%. Few years back, it was in single digit.
20% of their book is unsecured.
19.93% to be more
almost
precise.
20%,
yes,
yeah.
so 20% of their unsecured, of the total portfolio is in unsecured business, like you said, credit card, personal loan, etc. So,
and for Kotak, this is close to 11%. You're saying right now.
Yes,
as a percentage of the
10.7, 10.8 or something, about 10.5, 11% is what their portfolio is. But Kotak has an amazing underwriting standard. No taking away from the fact that their underwriting skills are really on the stronger side or superior side. I've not seen them having much of write-offs in a particular quarter or in a particular period. They are hands-on with their asset quality, and it goes in hand with what the industry is witnessing as well.
Okay, so all things put together, before we get into more specifics on ICICI Bank, for Kotak, would you say that barring the fact that there is higher treasury income, higher other income which has helped the PAT, and that's the one argument that some of the bears can make, that okay, that's why the profit was up, because you had this higher treasury income. Barring that one point, is there anything else that you would kind of not put as a red flag, but something more to think about, or do you think it's actually all in all been a very good quarter?
Why? Let's talk about that only. Treasury profits across lenders from loss to profit, quarter on quarter is seen. Like for SDFC Bank, the treasury profit was at 552 crores when compared to a loss of around 38 crores in the previous quarter. ICICI Bank, they reported treasury gains of about 252 crores. Last quarter, it was a loss of 40 crores. So Kotak Bank has reported 240 crore of treasury profits. That's it, versus a loss of 1 crore in the previous quarter. So I mean, across industry, they are seeing an uptick in the treasury gains. That's okay. Take it with both hands. That it's across lenders. It's not just one-off for Kotak or anyone. In fact, SDFC Bank has had the most treasury gains if you take a look at the numbers per se in terms of profitability. So that's
not much of
a trouble.
Got that. Okay, so let's now talk about the strengths and weaknesses with respect to ICICI Bank. Some of the trends we've already discussed. ICICI Bank has also had this phenomenal growth in their unsecured portfolio, and that's where that's what's powering at least the loan growth, right? So loan growth, no problem. What about margins, overall cost of funds for ICICI Bank? What's the read through this quarter?
Across banks, expect one more quarter where the cost of funds can rise.
Okay.
ICICI Bank also reiterated in their con call that they will see cost of funds rising in the next quarter. So it is like an industry phenomenon where cost of funds will rise. Incremental funds are coming in at a higher cost because of the interest rates environment that we are in. So one more quarter where cost of funds can rise, the net interest margin can come down, but how much will it come down to? It won't come down materialistically that you have to be worried about. Even on average basis, you know, FY23, FY24, if you take a look, the net interest margin would be on the higher side when you compare to 10-year average. Typically, just to educate our viewers, you know, earlier 3 to 4% kind of net interest margin was really on the healthier side. 4% margin, the bank is phenomenal. They say that, I mean, everything was good. Now we are worried about a 4.9% net interest margin declining to even 4.5%. I mean, take it with both hands that even 4.5% is pretty good. Why? Because efficiency is improving. Cost to income ratio for many banks is now within 35-45% kind of a range. Earlier, when they used to make a 4% margin or 3.5-4% margin, the cost to income ratio was north of 50%. So operating efficiency is improving. ROA today, all the banks are touching the 2% level, which is phenomenal. Trust me, 2% ROA for a banking business in India is phenomenal. And even then we are talking that our ROA of Kotak Bank, you know, for example, is at 2.8% on a quarterly basis. You cannot ask more than that from a bank in terms of its performance.
Okay, so you're making a strong argument there, and that explains that, you know, the kind of move that we've started seeing in bank stocks, the catch-up rally has started. But again, just to kind of nitpick a little bit, again, to go back to that point on the unsecured book, 40% growth year on year in personal loans and credit cards. It just tells you, I guess that's where the yield is better, right?
The yield is phenomenal.
So that's where the banks
are chasing. It's far better than giving home loans. You are taking a home loan at whatever rate.
9%, 9.5%, whatever.
I'm just comparing the yields. And you take an unsecured product. 500-600 basis point gap is there, minimum.
So might as well give personal loans out.
Personal. Credit card, if you are taking a loan, but 30-36% is the kind of yield that you get.
That brings me to another very interesting point. I remember we discussed this, I think, last week on the show in some other respects as well. This, risk-weighted assets, that RWA ratio, that is also going up, right? Because
Q1 is seasonal.
More and more of your book is going on the unsecured side.
Q1 is seasonal. Q1 versus Q4, you will see a rise because there are some operational cost, operational risk or credit risk that's been built in, but that's okay. Even then, if you compare to the averages, it's on the lower side. And when you are taking, that factor of risk hai to ishq hai, that's the fundamental that plays out. If you take certain risk in your portfolio for better yields, right now, the underwriting standards have improved. We are not in the banking sector, which 10 years ago, if it defaulted, straight away write off. No, today there are many backups that banks have done to ensure that recovery is there, even if it falls. The underlying security or the underlying quality of book has improved a lot. So even if they are growing, it's not a worrisome factor because the underwriting skills have improved for the entire banking sector as a whole. So one may argue that, for example, Mr. Sandeep Bakshi of ICICI Bank has been concentrating really on the unsecured portfolio, but it's within a bandwidth that credit cost has not increased to that extent that the book has increased, and it's been 3 years. So one tenure or one period of cycle you have seen whether the book can go bad or not. Nothing has happened so far. So far so good. The banking sector has witnessed unsecured portfolio increasing, but it's within controllable limits, or let's say under control.
One thing we didn't talk about, all the major three lenders have reported, HDFC Bank, ICICI Bank and Kotak now. Corporate loan growth has started picking up for all of them, right?
Corporate loan growth is not capex growth that is coming in. It might be due to the fact that money market rates are very high. Even now the 3 months CP commercial paper is trading above 7%.
Oh, okay.
So it's better not to borrow for 3 months at 7%. Just go to a bank, take a loan of 8% for the year, 8-9%, whatever the rate may be. It works out to be much cheaper, much faster. You get immediate money, and you get quantum. CP, you'll have restriction with respect to quantum, 3,000, 4,000 at the upper end. How much can you hold in the book and all that? And over here, from a bank, you can just withdraw 10,000 crore if you need. So in that sense, funding becomes easier. It's all short-term loans that are happening. I have not heard any bank talk about
major capex and
nothing is happening on nothing on project loans being dispersed.
But anyway, I guess all in all, you'd say healthy trends for private sector banks so far?
Healthy trends, yes. ROA is holding up really well, which is a heartening point to see. If ROA is not holding up, then we are in for a worry. But you look at HDFC Bank, 2% above ROA, 2.39% for ICICI Bank, which is quarterly high, 2.8% for Kotak Mahindra Bank. No finding fault if they are making 2% ROA. Just be happy that the results are strong.
Okay, so far so good on the private sector banking side. Abhishek, thank you for joining in and helping us make sense of all of those numbers that have come in. Well, with that, we are going to take your leave on this edition of Who Moved the Market, but earnings season is underway and I'm sure we'll have more interesting financial numbers to discuss with Abhishek in the shows ahead. Thank you for tuning in today. We'll see you again tomorrow.